In this video, we're going to discuss the impact of the financing decision and financial distress. In previous videos, we've talked about how taxes affect the decision. We've talked about how perfect capital markets set the foundation for the decision. So now we have to conclude with what are the issues of financial distress and how does that affect management's decisions within the company? So financial distress is when a company just has difficulty meeting its debt obligations. Default is the extreme case of financial distress, where you actually do not make those obligations, right? So if a firm defaults, the debt holders have the right to the assets of the firm. They could even take ownership of the company's assets themselves through bankruptcy. So default is obviously very serious. So an important consequence of leverage is this risk of bankruptcy. Equity financing doesn't have that risk, right? There's no obligation to return anything to the shareholders of the company, right? It's not legally obligated to pay dividends. It's not legally obligated to do anything for the owners of the company. So let's talk about an example, see if we can lay the path for this, right? So we have a company, they're considering a project. If this project is successful, it'll be worth $150 million. And if it's a failure, it'll only be worth $80 million. Now, we are going to have one of two structures. We're either going to do an all equity financing, or we're going to spend the $100 million for this project. So if the new project is successful, it's going to be worth $150 million. So without leverage, the equity holders get this full amount. With leverage, the company obviously has to pay the $100 million in debt, but the equity holders still get $50 million. So even if it doesn't have this $100 million to pay the debt, it could always go out and borrow to make the payments on that $100 million. So in this case, really, if it's successful, it really doesn't matter what happens. The owners, the current equity holders, will benefit. Will they benefit $150 million if it's all leverage, or will they benefit $50 million if they borrow? It's still $50 million at least. So as long as the value of the assets exceeds its liabilities, again, they're going to be able to repay this loan, right? They might not have the cash immediately available, but they can go out and borrow it. So if the firm has access to capital markets and it can issue new securities at a fair price, then it need not default as long as, again, the market value of its assets exceeds its liabilities. So in this case, really, negative cash flows, even for a couple of years, right, is not, you can still remain solvent as long as you have the ability to raise capital. What if this new product fails? Now it's only worth $80 million. So without leverage, the equity holders lose $20 million, right? Cost $100 million. It's only worth 80, so they lose $20 million. With leverage, they're going to experience some financial distress, right? In bankruptcy, the debt holders will receive ownership of the assets, leaving the equity holders with nothing. Because the assets, because the debt holders receive 80 million, they suffer the $20 million loss. So with leverage, we lose 20 million as owners. With leverage, the debt holders lose the 20 million. So both debt and equity holders are obviously worse off if it fails. Again, as we mentioned, without leverage, if the product fails, equity holders lose, again, a total of 70 million. It goes from could have been worth 150, now it's only worth 8, so they actually lose 70 million. And the leverage equity holders lose 50 million, and the debt holders lose 20 million. But still, the total loss, regardless of which direction, is a net of $70 million. And as we can see here, without leverage, it's 150 or 80. With leverage, it's still 150 or 80. So it really doesn't matter with these two scenarios, right? If the new product fails, Armin's investors are equally unhappy, whether the firm is levered or whether it's unlevered, right? So the decline in value here is not caused by bankruptcy, right? The decline is the same whether or not it has leverage. So if this new product fails, the term here is economic distress, which is a significant decline in the value of the assets of the company. So let's think about, in a world with perfect capital markets, Medigli and Miller's Proposition 1 applies. The total value to all investors does not depend on the capital structure. There's no disadvantage to debt financing, and a firm has the same total value and can raise the same amount initially from investors with either choice. So again, in this world of perfect capital markets, we're basically saying it doesn't matter what the company does, the value to the company is the same. What is different is how that is distributed, right? Between the two sets of owners, the equity owners and the creditors of the company. So this is going to be some shorter videos through this discussion. There's quite a few of them, but I wanted to break it down into some smaller parts, if you will. So I'll see you in the next video.